Good day, and thank you for standing by. Welcome to the Pilbara Minerals June 2023 Quarterly Activities Conference Call. At this time, all participants are in a listen-only mode. After the speaker presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star 11 on your telephone. Please be advised that today's conference is being recorded. I would now like to hand the conference over to your speaker today, Pilbara Minerals Managing Director and CEO, Dale Henderson. Please go ahead.
Thank you, Andrew, and hello, everyone. Welcome to the Pilbara Minerals June quarterly call for 2023. Firstly, I'd like to acknowledge the traditional custodians on the land on which our businesses operate, the Whadjuk Noongar people in Perth, who are undertaking our call today, and up north where our operations are, the Nyamal and Garryara people. We pay our respects to their elders past, present and emerging. For the call today, we'll have two other speakers to myself, being Luke Bertoli, our CFO, and Vince DeCarlos, our Chief Operating Officer. And we'll also have some Q&A with Alex Eastwood, our Chief Commercial and Legal Officer. Also within the room today, joined by a number of the team. Welcome to all. As to the flow for today, same flow we've done typically. We're going to try and keep to an hour in the knowledge that others have got other calls to go to. We'll be stepping through a short presentation, then to 20 minutes of Q&A with the analysts, and then 10 minutes of webcast questions. Now, moving to our presentation, slide 2, just a quick recap on our strategy. Our aim and our vision is to be a leader in the provision of sustainable battery materials products. And we're absolutely getting on with the job. And in many ways, we are a leader in this space, whether it be some of the innovation we've done, whether that's BMX, our tolling arrangements, and the improvements we've made in recovery, or just our scale. We are moving forward in leaps and bounds. But in service to our aim, our strategy comprises 4 key legs. The first and foremost is the operating platform. We want to make sure that operating platform is shooting the lights out quarter after quarter and shift after shift. I'm pleased to report in this quarter we've been doing exactly that. Beyond that, we're wanting to grow the operating platform and make the most of this incredible Tier 1 asset that we have the privilege of stewarding into life, the Pilbara asset. Third leg of our strategy is around chemicals. We're looking to participate more deeply into the chemical supply chain such that we're extracting more value per lithium unit and channeling those incremental value back through to our shareholders. And lastly, it's about diversification and being able to move beyond the Pilbara asset, which we're in no hurry to, and we'll obviously, if we are to do that, we'll do that in time. Now, moving from slide 2 to slide 3, touching on the quarter, which was, we have had a cracking quarter, topping off a cracking year. On the top line there, you'll see our operating performance. Production, a 10% increase on the prior quarter to 160,000 plus tonnes, and that's a 64% increase year on year. Sales, another record broken, 22% increase on the prior quarter, and a 68% year on year increase. And then that's playing through to the balance sheet, a 24% step up in the balance sheet here of those stronger volumes and healthy pricing. And from a year on year basis, it's a 464% increase on the prior year. So an incredible set of numbers from the operating platform. Moving to the blue boxes, which speaks to those legs 2, 3, and 4 of our strategy. As it relates to growth, expansion is well underway. I'm pleased to report the P680, a primary rejection expansion project, which delivers us the next 100,000 tonnes, is tracking well and on target. And that will give us another 17% step up in produced volumes. Midstream is moving forward to an FID, and then the POSCO Pilbara lithium hydroxide joint venture is on target, both CapEx and schedule. So looking forward to seeing Moving to diversify, the partnering process well underway, and we'll offer a couple more comments on that later. And then exploration. We completed a 46,000 metre program. The mining team are busy crunching the numbers, and we look forward to updating the resource and reserves in due course. So an absolutely cracking quarter, which is rounding off a cracking year. And with that, I'd like to just thank the team at Pilbara Minerals and our contracting partners. It's not been easy. Growing is tough, and growing in lithium is particularly tough. Building and operating these lithium mines is really, really difficult. And Pilbara has honed expertise and know-how in this regard, and it's on show today. So thank you to the team out there for all the teamwork across the full Pilbara team, both our head office and side team. I know it hasn't been easy, but well done to you guys. You deserve all the credit for this in combination with our contracting partners. And that completes a quick summary. And for that, I'll now hand to Vince for a bit of a quick update on the operations.
Thank you, Dale. Starting with on slide 5, we're starting with safety. You can see our lead indicator safe interaction continues to trend strongly. In the fourth quarter, we ramped up our critical risk management training and awareness, and we expect this to deliver improved safety performance in FY24. However, it does need to be noted that our focus and energy is yet to translate into one of our lag indicators being total recordable injury frequency rate, which has increased from 3.5 in the March quarter to 4.7 June quarter, due to a high frequency of low severity soft tissue injuries. This has in part been due to a rapid increase in new employees, particularly in mining and expansion projects such as P680. However, we have a strong and defined safety program for FY24, and we expect this will deliver positive improvements in safety performance and culture. We've also been delivering on our commitments flowing from our first cultural engagement survey, completing a number of improvements that support an enhanced work environment. Amongst recent improvements include new workshop facilities, a new administration precinct at a Nugget operation, more than 400 additional new rooms, and a new and upgraded gym, just to mention a few, with others to come as we move into FY24. Pleasingly, our voluntary turnover continues reducing quarter on quarter, and our female employment is just under 23%. Moving on to the next slide, moving on to volumes. Production was broadly in line with our expectations and a record for the quarter, with a strong performance from both processing plants, and sales delivered a record also. I can also confirm that this production volume we achieved at the upper end of the previously reported production guidance. In processing, the strong quarterly performance was attributed to a combination of a number of improvements. Starting off with improved recoveries, it was 70% for the quarter versus Q3's 66%, due to the implementation of recovery projects and increased focus in ore hygiene practices. We also successfully achieved our first 10-week shutdown cycle from our previous 8-week cycle, which contributed to a combined improved availability for the quarter at 87%, which was on plan and improved on Q3's 85%. Processing rates were also strong and improved on Q3, and that's attributed to our ongoing asset management program and continued focus to improve our systems and processes. And moving on to mining, we achieved a record in mining for the quarter, mining 8.5 million weight metric tonnes versus 7,798,000 wet metric tonnes last quarter, which was a 10.1% improvement quarter on quarter, which is a great result. Our mining uplift plan is gaining traction, inclusive of additional resources yielding improved utilisation rates, investment into new equipment resulting in improved availabilities and mining productivities, and we've also implemented new mining facilities within the quarter, inclusive of a HME workshop and a drill and blast workshop, again, just to mention a few. And finishing with costs, our costs have fallen within the middle of the range of our cost guidance at $613 per dry metric tonne FOB, and our guidance was $600 to $640. Our cost base was revised last quarter due to cost pressures across three areas, being inflationary pressures, one-offs, and pre-investment. At this time, we're seeing these have stabilised, and we will guide our updated cost expectations as part of the end-of-year results. With that, I'll hand back to Doug.
Thanks very much, Vince. Now moving to our expansion, slide 8. As I mentioned in my opening remarks, the P680 expansion project, specifically the primary rejection component, is on track, which will be delivering us an additional 100,000 tonnes worth of production capacity. So delighted with the progress there with our team, Primero, build partner. So well done to Paul Labourne, our project director and team. Great to see the progress on that. The other part of the P680 project relates to the large crusher and ore sorting facility. We have phase shifted that to the right by 2 quarters, and principally that's owed to redirecting resources to the primary rejection works. Now, I'd highlight that the large crushing ore sorter is required to support the P1000. It's not required for the P680. The new crusher ore sorter is sized for the larger operation with additional crushing capacity. We don't need that for the P680. Hence, we've, as you'd expect, prioritised the increase in tonnes from P680 primary rejection. As it relates to the broader P1000 project, good progress happening there with long leads order. Engineering is underway, and we're on track for that one, so that's going well. And looking forward to bringing both these incremental step-ups to the operation. It's remarkable to think that year and a half to 2 years, we'll almost be double where we are today. So if you think about that production capacity times healthy pricing, Pilbara stands positioned to be a healthy cash flow generator, of course, subject to the prevailing market conditions. That completes the expansion update there, and with that, I will step now to the chemicals update. Moving to slide 10. The midstream project is progressing. We're heading towards our FID. A couple of highlights here: the government Modern Manufacturing Initiative grant fund of 20 million. That contract was executed during the quarter, which was great, and the team is effectively busy finalising the documents in support of the FID, the demonstration plant. For those who are not familiar with the midstream demonstration plant, what this is all about is producing a more value-added lithium product for market, and doing so using more renewable processing steps. If we get this right, the idea is we'll materially concentrate the lithium at the mine site, drop out the alumina-silicate waste, which is normally present with spodumene concentrate, and 3, materially step down the carbon energy intensity curve. All the work we've done to date is very positive around this. The demonstration plant, as the name suggests, is all about demonstrating the process at a reasonable scale, such that we can test this, the unit cost performance, recoveries, and all going well, set the stage for broader commercial application. So we're doing this in combination with our joint venture partner, Calix, another great Aussie company, and we're excited to be progressing this project, as could have big implications for our business and for the industry. So looking forward to progressing that project in due course. Moving now to slide 11. Joint venture with POSCO for the construction of a 43,000-tonne lithium hydroxide plant in South Korea is going well. As you can see from the photo, plenty of booms in the air, structures going up, and both those 2 hydroxide trains are on track. Train 2 being the first train to be complete and commissioned, so 65% complete, and the other train is at 35%. So very much in the construction phase right now. Commissioning for the first of those trains is to occur in the back half of this year, and excited to see that come to life. And this will be Pilbara's participation in lithium chemicals manufacturing, which is really, really exciting, delivering on an aim we've had since the inception of the project. So really excited to see this come to fruition in the coming months. Moving now to slide 13 on the partnering process. This is well underway. Nothing new to report here, but this is incredibly exciting process, and I would put it to all that this is probably one of the most exciting transactions available in the market. Exciting in the sense that we're offering up to 300,000 tonnes of spodumene concentrate, which effectively could support multiple hydroxide trains. Two, it's coming from Pilbara. In my view, and of course I'd say this is a completely de-risked proposition. The group knows how to deliver the product to market and will be delivering this product in short order. And three, yeah, it's got the scale. Yeah, as I mentioned, 300,000 tonnes is not insignificant, supporting multiple hydroxide trains. So we'll see how we go. The process is we're in mid-flight with this. It's a long-term contract offer we're providing here, and it wouldn't surprise you that we've had a lot of interest. If we look in the rearview mirror, the first time we ran a process like this in 2017, you could count the participants on one hand, and ultimately what flowed from that process was a joint venture with POSCO. Fast forward to today, the long list is something more like 70 odd, but of course we are looking to, and we are shortlisting down to a much smaller number. We're in progressing discussions, but I mentioned that just to highlight the interest in the industry and how much the industry is rapidly evolving and growing. It's really exciting, and Pilbara stands poised to do something pretty exciting here. We'll see how we go. Now that concludes this section, and with that, I will hand over to Luke to take us through the financials for the quarter. Over to you, Luke.
Thank you. Thanks, Dale, and good morning to those on the call. Please turn to slide 15 of the presentation. This slide sets out the group's financial metrics for Q4 FY23 versus Q3 FY23. Group revenue was $844 million in Q4, representing an 18% decline period on period. The June quarter showed an improvement in production of 10%, as mentioned earlier, and an increase in sales of 22%, which partially offset the impact of softening prices by 33%. At the unit cost level, unit operating costs on an FOB basis in Q4 were broadly flat at $628 per tonne versus $632 in Q3, with higher mining costs driven by the 10% increase in material moved, offset by higher sales volumes. Unit costs on a CIF basis were $976 per tonne in Q4, a 15% improvement on the prior period, reflecting lower royalty costs associated with lower revenue and lower shipping costs. Turning now to slide 16. Slide 16 sets out the group's financial metrics for FY23 versus FY22, with significant growth shown across all key metrics. Group revenue grew to $4 billion for the financial year, up 238% on the prior period. Strong customer demand reflected in higher pricing and a material uplift in production were the key drivers of FY23 revenue performance. Sales volume grew by 68%, and average estimated realised price was up by 87% on the prior period. In terms of unit costs, on an FOB basis, costs increased 11% to $613 per tonne for the financial year. All key components of operating costs were higher than the prior period. This, however, reflected pre-investment in mining for P680, targeted investment in spares and maintenance to improve availability and productivity, and ongoing enhancements to our facilities to cater for the growing operation. As mentioned previously, throughout the year, our unit costs were also impacted by labour shortages and inflationary pressures. On a CIF basis, costs increased to $1,091 a tonne from the prior year at $844 a tonne, up 29%. This cost increase was primarily driven by higher royalty costs due to higher sales revenue. Turning now to slide 17. Notwithstanding the decline in revenue largely driven by prices in the period, we saw continued solid cash operating margin and very strong growth in cash in the June quarter. Cash margin from operations was $920 million in the period, comprising $1.1 billion from sales of concentrate to customers, less $201.9 million of operating costs to produce and sell concentrate. Pleasingly, net cash margin from operations of $920 million was broadly in line with the March quarter at $919 million, notwithstanding the decline in revenue. Further down the cash flow statement, there were income tax payments of $120.9 million. There was a total cash flows from investing activities or CapEx of $160 million, and there were net proceeds from borrowings of $19.7 million, a cash inflow, and a cash outflow of $21.4 million related to other financing costs, including interest and lease payments. Strong revenue growth and in turn, strong cash operating margin led the group to close the quarter with a cash balance of $3.3 billion, a $655.5 million increase over the $2.7 billion recorded as at 31 March. This increase in cash compares favourably to the $456.5 million increase in the March quarter, albeit that quarter included the company's inaugural dividend payment. I'll now hand it back to Dale.
Thanks, Luke. Correct the numbers there. Brilliant. Moving to the last part of our presentation on the market, and as for previous calls, I'll put my commentary into three categories. A little bit about the long-term outlook. I'll then step into the June quarter and touch on our observations. And then lastly, looking outwards, Pilbara's view of the market and how that's guiding our decisions. So starting with the long-term outlook, it's incredibly positive, and there appears to be a sustained structural deficit unfolding. And it doesn't matter which day's paper you grab, there seems to be new announcements day after day. And I'll just highlight a couple of the more meaningful ones we've had of late. The Biden administration is making available a $20 billion green bank for support of clean energy projects such as residential heat pumps, EV charging stations, and community schooling projects. The Canada government announced on the 6th of July to be providing $11.3 billion US incentives to Stellantis and LG for their battery plant developments. The International Energy Association released on the 12th of July some of the data they've produced comparing the year of 22 to the prior year 21. They note EV sales reached a record high of 10 million in 22, which is a tenfold increase in just 5 years. They noted that renewable electricity capacity additions rose by 340 gigawatts, the largest ever development, and that was in the year of 22. They also noted that investment in clean energy reached a record 1.6 trillion in the year of 22, an increase of almost 15% on 21, demonstrating continued confidence in energy transitions, even in an uncertain climate. So that's from the IEA. As we look to some more EV-specific news points, we've had some Chinese policy support recently around EV subsidies, and also more recently, the China's National Development and Reform Commission have outlined a suite of initiatives to promote automobile consumption and new energy vehicle support. And then there's actually the data around EVs themselves. China specifically at 44% year-to-date growth compared to H1 and 22, a 36% quarter-on-quarter increase for China. Moving to the more global EV picture, China, US and Europe combined, 39% year-to-date growth for H1 22 and a 30% quarter-on-quarter increase. So at the macro level, there is just massive moves afoot around energy transition, which of course lithium is a key enabler and stands poised to be a great market to be in for a long time to come, given the necessary role lithium is going to play. So that's at the very sort of high level macro picture. Stepping now to our June quarter observations, starting of course with pricing. What we saw of course was pricing stabilised. We've had that sort of down dip through the March quarter, then sort of uptick, and it's been relatively stable. Speaking with a few of the commentators in the market in the last 24 hours, they note that volatility continues to play out. And with those thinly traded volumes and very few data points around the market, what happens is you typically, in lithium, get outsized responses. And it's worth touching on the Guangzhou futures trade, which happened last Friday, which was for a futures contract for January onwards. That contract went lower than expectations, and the market response, in our view, was outsized. And the read of that one contract was one of, that must be the direction of the market. All I would say is I caution everyone that these types of data points, whether it's the Guangzhou exchange or the Wuxi exchange, we have seen in the past outsized responses to small contracts and small volume movements. And I'd encourage people to step back and look at the macro drivers, because from our view, they remain very strong. And specifically as it relates to our customers, demand remains strong. We have no issues moving our product. It flies out the gate. The question is what pricing, and we have an abundance of offers to sell and customers to sell product to if we were to choose to. So given this noise that you hear around some of these, as I say, other market trades, I'd just like to reassure you from our perspective, this is a great market. We're having no issues selling our product into this market. And the quarter we've just had demonstrates just incredible returns here of a strong market and, frankly, strong pricing. So we remain very positive about where we're at, which takes me to really those last comments of what does this all mean for Pilbara? So we have conviction around this market and our growth plans. We are in the best market at the best time, delivering possibly one of the best assets. So we continue to keep the foot down. The throttle is jammed wide open, and we're looking to develop and expand as rapidly as we can to make the most of this incredible market. It's an amazing time in history, and Pilbara finds itself in an absolutely unique position. We were an early mover. That was tough, but that has now flipped into the most incredible opportunity that we are absolutely focused on making the most of. So looking forward to seeing how this market unfolds in the years to come, and I think we're incredibly well placed and looking forward to, touch wood, delivering many good quarters to come for our shareholders. Okay, so that completes the market commentary, and with that, I'd just like to hand back now to Andrew, the moderator, to go to Q&A. Thank you, Andrew.
Thank you. As a reminder, to ask a question, please press star 11 on your telephone. Please stand by while we compile the Q&A roster. And our first question comes from the line of Hayden Bristow with Macquarie.
Good morning, Dale. Thanks for that. Just a couple of quick ones for me. Firstly, just on the spodumene pricing, just keen to get an understanding. Is there any sort of changes in the market? Are we starting to see variances in discounting as your product grade falls, or a greater focus on impurities, or is it all just the difference between what we worked out versus what you delivered was really around just timing on each month on shipments versus the different pricing indexes you use?
Yeah, that's right, Hayden. Yeah, that's right. It's the latter. It's not a case of the former. It's not a case of spec changes or other discounts. It's more the makeup of the reference points and timing.
And just the second one, just on the sort of the growth outlook organically, I mean, just worth, I guess, touching on, we've seen a few others struggle with recovery rates as they ramp up. There's nothing different you're doing really other than mining more material, are you, in terms of pushing towards the P1000? Everything else is pretty much exactly what you have now?
Pretty much, yeah. I like to think that we've honed the recipe for lithium concentration for our particular ore body and mine site. The expansions which we're doing are effectively copy-paste of that recipe, but there's more upside to come. So the team, as you'd expect, is doing a suite of improvements to eke out more and more recovery, because that's the business we're in. And the likes of the new water and P1000 with a few whistles and bells which are coming in as part of that, which will help improve recoveries further in time. Yeah.
Yeah, okay, great. All right, I'll leave it there. Thanks, mate.
Thanks, David.
Thank you. One moment for our next question, please. Our next question comes from the line of Levi Spry with UBS.
G'day, Dale and team. Thanks for your time. Maybe just can we flesh out the realised price a little bit more? I suspect it's disappointed a few guys on the street. I'm getting lots of questions on it. So how do we go about forecasting it, given the data that we see from the price reporting agencies and your 5.3, 5.4% grade?
Yeah, Levi. Yeah, appreciate the price is always a struggle. And you recall some quarters we surprised the street, and other quarters like this one it's slightly under. And largely this has all been this was around timing principally. Each of the offtakes we've got have got commercial relationships with each of those offtakers that we can't really divulge the specifics of. But there are minor variations which play through. But I would stress that the timing is a key component. And unfortunately, I can't divulge too much on the specifics there, Levi, given the commercial sensitivity.
Okay, I'll try one more on it. So what price are you seeing now in the context of the weaker Chinese prices? You mentioned the Guangzhou one, but the Wuxi and, what price are you seeing right now?
It's pretty stable at the moment, Levi. I think the pricing we've realised is not a bad go by. But, just highlight that our pricing is exposed to where the pricing outcome in the future, effectively. So the prevailing market is what sort of ultimately affects the realised price. So if we see a rise in chemicals pricing, we'll see a rise in our realised price, and conversely. So it is a bit of crystal ball gazing. So you've got to take a view of what the future pricing is.
Okay, thank you. And maybe just one last one, slightly different one. On the partnering process, you mentioned very large contingent of parties initially, and how it compared to when you did the deal with POSCO. Can you talk to how the industry may have changed or may have not changed in terms of the likely outcome here? So capital intensity, margins, things like that. Can you just throw a few data points at us in terms of the range of outcomes we can expect?
Sure. I probably can't give you the detail you're chasing there because we are early in the process. But to the broader concept of has the lithium industry changed, it certainly has. It is it is very much a global industry now, and we're seeing new parties are looking to enter entrepreneurial groups. We're seeing the old hands in the industry continuing to expand, and of course we're seeing car companies and the like, and other types of groups who historically probably wouldn't have played in this space, all getting on with it. So it does feel like the world's our oyster for Pilbara, which is a great place to be. As to the specifics around which projects, which parties, and we're well too early in that process. But we are, as you expect, narrowing down to quite a small group that we're liaising with in this regard, and look forward to updating and providing some more detail on this later in the calendar year.
Okay, thanks, Dale. And last one.
Sorry, his line dropped. One moment for our next question, please. Our next question comes from the line of Kate McCutcheon with Citi.
Hi, good morning, Dale. Following on from Levi on the downstream partnering plan, are you wedded to hydroxides? I guess given the LFP mix is growing, is carbonate something you're considering? Curious to know how you think about the future of the chemicals mix, I guess.
Okay. Yeah, good question. We are not wedded to a particular chemical at this stage. We're keeping our mind open to all opportunity. It's too early to guide as to what that looks like. It's probably worth also adding that this concept of producing a midstream intermediate product is something we, of course, think deeply about, and that too would be part of the discussions around whomever we ultimately partner with. I think ultimately the world needs a better intermediate product than spodumene concentrates, and given that this type of contract and partnership is a multi-decade type relationship, we're of course considering what would an intermediate product supply chain look like. So that's part of the thinking. But yeah, too early to sort of guide on which products we're chasing. But yeah, look forward to updating more later in the year.
Okay, no, that's helpful colour. And then have you had any further thoughts on concentrate grade moving forward? Would it be fair to assume 5.3 is the new 6 moving forward for Pilbara? And if so, how should we think about the P680 nameplate on that lower grade?
Yeah, good question, Kate. Yeah, our objective is to keep the product grade around where it is, north of 5%, but somewhere around where we are now, for the principal reason that this enables us to maximise lithium recovery from the mine site. And so our objective is to continue that as long as we can. But of course, we need to make sure the customer and market supports it, which it does at this time. So provided that persists, we'll continue to do that. What does that translate to for the P680 and P1000? Ultimately, it does give us a bit more upside in terms of produced volumes. If you go back to the P1000 FID, you'll see that there's a bit of extra information there around what a 5.7 grade looks like. Moving to a 5.2 or 5.3 does give a little bit of upside above that, which we'll look to do, as I say, provided the market supports it.
Okay, and then finally, just a quick question. One of your peers reported a pretty large exploration budget for next year. Can you just remind me how much you're spending on exploration each year at Pilbara?
I don't have those numbers on hand, but it'll be a modest spend, somewhere less than 20 mil. It's likely what we'll be doing for the year ahead.
Okay, perfect. Thank you.
Thanks, Kate.
Thank you. One moment for our next question, please. Our next question comes from the line of Tom Hayes with CLSA.
Good morning, Dale and team. Just a few follow-ups. Maybe I'll start with the one that Hayden asked. So we've seen sort of recoveries increase to 70% and sort of implies a head or feed grade around 1.4. I'm just wondering, what does that grade profile look like over the next 2 years as we sort of move beyond the higher grade in the central pit, referring to the mineral resource and reserve statement, and noting that it's sort of lower iron oxide. So I'm interested, what interplay that will have with recoveries, or does the new kit that's going in sort of offset that?
Yeah, good day, Tom. So as it relates to the head grade we've had to date and in the next couple of years, it is elevated, and that's we've been upfront with the market since the inception of the project around that, and it's just a function of the way the ore presents. Where does it take us in terms of recovery long term? We've guided sort of a 75% recovery long run average, with a long run head grade of approximately 1.2. Now we haven't been at 75% consistently of late, albeit there has been some improvements. What will take us up the curve and you alluded to it, is we do have some levers coming as part of the upcoming expansion projects, which will enable effectively more levers for the team to eke out a few more recovery uplifts. And the other piece which adds to this is the ore petrology work the team are doing continues to advance. And what that's about is being able to marry mineral variation with bespoke set points of the processing plant, which in combination equals higher recovery. So, the improvement journey continues and it won't stop. We're a multi-decade operation, and the team will keep focused on eking out every percentage point that we can for recovery.
Thank you for that. And maybe just a follow-up, just sort of looking at the downstream, sort of trying to get an idea for further, processing data points. I guess we've seen across sort of the Aussie lithium peers quite different approaches to adding downstream lithium hydroxide capacity. I'm just wondering how you're thinking about sort of the competitive advantages of your strategy versus, say, domestic or US or China downstream strategy. So, what are the key benefits or key risks that you'd like to call out that gives you sort of conviction in your strategy, which to date has targeted experienced chemical producer in the battery raw materials value chain, based in Korea?
Yeah, thanks, Tom. Good question, and one we wrestle with. And I think, the whole industry is wrestling with this, given it's the emergence of an industry. And so we're seeing many different ways to skin a cat effectively emerging. To date, of course, we've had a joint venture with POSCO, and in many ways we felt that ticked a lot of boxes and that it was an existing battery materials hub, a good cost domicile, a group with know-how to build and operate that operation, and good set of commercial terms. I referenced that as a bit of an example of ticks in the boxes. As to where do we go with this partnering process, we are looking globally at all the options. Each proposition has a complete different set of attributes, but broadly speaking, the things we're interested in supply chain integration, whether an established battery materials hub or not, or one to be in the future. 2, the commercial return to our shareholders, equity percentages, etc. 3, alignment around sustainability objectives. 4, government support or the participation to be part of a government-supported supply chain, a la IRA, and technical know-how. Those are to name but a few of the key parameters that we think through as we wrestle with this challenge. But I appreciate for those observing the market, there's some quite different approaches being deployed, and everyone's doing something different, it appears, at this stage. Thanks, Tom.
Thank you very much. I'll leave it there.
Thank you. One moment for our next question, please. Our next question comes from the line of Kaan Peker with RBC Capital Markets.
Good day, Dale and team. Congrats on the strong quarter. 2 questions on the growth assets. The first one, just want to get a bit more of an understanding around the POSCO JV. Why Train 2 is ahead of schedule relative to Train 1? What's the differences between the 2 trains? As far as I understand, they're different technologies. Maybe if you could expand on that, and I'll circle back with a second.
Yeah, good day, Kaan. So, Train 2 is you're correct, there were 2 different trains, and those 2 trains use different lithium hydroxide processing routes. Train 2, which is the one which is being delivered first, utilizes POSCO's patented bipolar electrodialysis process, which POSCO have developed many years ago. That's Train 2. That's one to be delivered first. The other train uses the conventional sulfate route. You might ask, why are 2 different trains deployed? Well, the truth is it's all about cost of production, and each of the trains, depending what cost inputs are, one may win over the other. The conventional sulphate route requires more chemicals, whereas the electrodialysis route requires more electricity effectively. So depending what those cost inputs are, one may win over the other. The discussions we had with POSCO were they were keen to deploy both technologies as a bit of effectively a way of hedging and a way of working through which process route might be best optimised for the future for that location. Hopefully that fills in some gaps, Carl.
Yeah, sure. Thanks a lot. Appreciate the detail. And the second one is on the P680. I think you mentioned, or it sounded like the delay was related to labour. Just sort of cognizant that CapEx spend is probably a little bit slower. Is there anything specific in terms of equipment delivery or infrastructure that's related to that delay, or is it just more labour? Thanks.
Yeah, you're correct. It was more labour and resourcing, not driven by long lead equipment. Thanks.
All right, thanks. I'll pass it on.
Thank you. One moment for our next question, please. And our next question comes from the line of Al Harvey with JP Morgan.
G'day, Dale. Couple from me. Just looking at the cash tax paid in the quarter, it did look a bit lighter than I'd expected. You had previously mentioned some instalments on the prior tax bill, so just wanted to get an understanding of what's left to be outstanding tax for cash tax paid over the rest of the year from prior quarters and any other lag effects we should be aware of there.
Good morning. It's Luke here. I can take that one to answer. So in the quarter, there was around about $121 million of tax paid. Since April, we started paying tax or income tax on a monthly basis. For the FY23 period, there are 9 months before April where cash tax hasn't been paid, and a make-whole payment will be paid in December this year when our FY23 tax return is lodged. So there'll be a cash tax payment around December for that 9 months of tax not yet paid.
Cool, thanks for that. And then just back onto the pricing, I guess we saw inventory movement trickle down for the first time in the last few quarters. Just trying to understand the decision to move volumes, more volumes into the market with prices moving lower. How do we interpret that on what you're thinking about near-term price trends? And I guess just as a second part to that question, what is the approximate storage capacity of finished product at Pilbara?
On the first part there, in terms of timing of sales and shipments, as a policy, we haven't tried to play the market. We have always taken the view of that the market will rise and fall, and some of those rises and falls happen very quickly. So rather than preempt that, we've taken the view that as we will produce, we will move and sell the product. So any surge which is played through in terms of our sales, like the quarter we've had, is actually just driven by logistics, shipment timing, and sales moving from just tipping over from one quarter into the next. So no strategy on our part to sort of play the market timing. And I appreciate that some of other lithium operators have talked about doing that, which is a bit different and fair enough, but on them. Can you just recap on your second question there?
Yeah, sorry, Dale. Just trying to get a sense of what the storage capacity of the finished spod concentrate is at Pilbara. I guess, over the last couple of quarters, it looks like it's built up to about 40,000 tonnes. Just trying to get a sense of where that could cap out.
Yeah, sure. No, we've got no shortage of space at Pilbara, so we can effectively store as much as we want. But that's not what we want. We want to be liquidating finished product as quickly as we can. We have some storage limitations at Port Hedland, but they're still fairly significant to the tune of 60,000 tonnes covered storage, that type of thing. But on site, there's no shortage of space if we chose to store more product there.
Great. And just a final one before I queue up again. Just trying to get a bit more of a sense of what drove that delay in the commissioning of the crushing and ore sorting. So you mentioned labour there. Just wondering if this does flow on to impact the timing of P1000.
Yeah, look, I think the WA market is tight in terms of construction and engineering resources. That's definitely present, and in effect, a component of that played through with the crushing ore sorting that we mentioned there. But I would not sort of translate that through to an impact on P1000. The team has factored in their expectations for this market into that schedule, and we're not anticipating any issues around that schedule. So we feel we've allowed for the market conditions there. So we'll see how we go.
Thanks, Dale.
All right. Now, just conscious of time, we're keen to move to the webcast questions. Now, for those whom we did not get to from the analyst calls, we will follow up with you with direct calls after the session today. And yeah, we're keen to move to webcast at this time.
Okay, thanks, Dale. And good morning, everybody. We'll move over to the webcast questions now. I notice we've got less than 10 minutes, so to the extent we don't get to every question, then we welcome shareholders to always reach out on our shareholder query line, and we can respond by email. So first question, there's a few questions around dividend policy. They mainly centre around timing for the next dividend and whether we'll maintain the policy or even consider increasing it. So I might pass that over to Luke.
Thanks, Alex. In respect to the second half full year 23 dividend, details of that dividend will be announced with the full year results announcement towards the back end of August. I can't speak to any specifics before that point, but there will be a full set of details in the announcement.
Thanks, Luke. Next question is probably for Dale and concerns the Calix JV. And the question centres on if the demonstration plant JV goes ahead, then what percentage of the million tonnes of spodumene would we be converting to midstream product before going overseas? So that's really the question. Dale?
Yeah, so the demonstration plant, by proportion, will only require a small part of a full production profile in the order of approximately 20 to 30,000 tonnes of spodumene concentrate per annum, which will translate through to something like 2,500 to 3,500 tonnes of a lithium chemicals product. So, yeah, by proportion, pretty small for the demo plant.
Yep, thanks, Dale. Next question is more around the batteries market. Do you consider sodium-ion batteries a threat to the demand for lithium?
The short answer is no, and we take a lot of comfort from querying our customers around this point. The sodium-ion batteries they appear to look like they are much more heavy and less dense, and there are some technical elements to them which make them more challenging to work with. But do they own a segment of the market? I think ultimately, yes. The likes of Benchmark have done some forecasts on this, and they're predicting it's quite a small component, but it looks more inclined to be deployed for mass energy storage rather than, say, the EV subset. There are hybrids occurring where it's a lithium-ion in combination with the sodium battery, but it appears that the lithium battery is very much required to achieve the necessary energy density requirements for the EV. So doesn't give us cause for concern at all.
Okay, thanks, Dale. Question, are we looking to acquire other businesses with our cash holding? This goes to our M&A strategy.
Well, we've got a BD team which is formed up and of course getting underway to consider inorganic growth opportunities. And as part of that, they will consider assets and businesses, and that's what they're here to do. And yeah.
Okay, thanks, Dale. Next question. Liontown are building a mine with 60% renewable power from day one, and BHP recently announced a decarbonisation strategy for their Pilbara mines that showed the economic benefits of decarbonising the mine site. Can the team please update shareholders on their mine decarbonisation strategy?
Yeah, of course. So we're down the path with decarbonisation already. The first step was deployed is a 6 megawatt solar farm, which is built, commissioned, and it's running today. As to the next steps of our decarbonisation strategy, we've got work underway on that as we speak, and we will be updating later in the year. But we're absolutely going to be taking decarbonisation steps as rapidly as we can. It's the right thing to do to market expectation, and we want to be as green as we possibly can, as quickly as we can. So we'll update the market in due course around what those next steps of decarbonisation look like later in the year.
Thanks, Dale. Question. Hi all. With so much growth, diversification in the near term, incredible operational performance in a tier one asset, and a very strong balance sheet, I'd like to thank the shareholder. Can you comment on the current share price? How do you feel PLS is being valued by the market?
That's a great question, Nathan. Thank you for that. Well, of course, we're very cheap at the moment. Of course, I would say that. Ultimately, I think what the whole market and those who sort of observe this market struggle with is what is the long-term price for lithium? That affects all valuations of all lithium companies materially. And if you go back in time to 2017 to 2018, the long-run lithium pricing, the spodumene is expected to be $600 to $700 a ton. Jump forward to today, we're seeing long-run forecasts of double that, or sometimes higher, depending which group. And there are some groups hypothesizing about going higher again. Where does it end up? Nobody, of course, knows. It's the birth of an industry, but that one parameter will have a material impact on the valuation of all lithium companies, including ours. But outside of that, what we're focused on is Nathan, what you've highlighted there, controlling what we control, making sure we do the best we can to shoot the lights out on the operation, expanding the operation, and making the most of this incredible environment. Thanks for your question.
Okay, quick question. It's of technical nature. What is the primary rejection facility?
Sure, I'll take that one. Without getting too deep into the technical nature of it, all that comes out of mines generally has gangue material. The primary rejection is going on to our Pilbara operation, and it's very early in the processing part. It's right up the front of the flow sheet, and essentially it uses dense media separation with specific gravities that reject a lot of gangue up front. The benefit of that is further into the processing plant, like our flotation circuits, it cleans up what is presented further into our operation, and by doing that, it also improves our unit costs. So that without getting into all the technicalities is probably the simplest way that I can explain it.
Okay, thanks, Vince, for that. Looking at the time, I think we've reached 8 o'clock, so it's time to bring the call to an end. I'll just pass over to Dale Henderson to close out the meeting.
Yeah, thank you all for dialing in. As we've taken you through, it's been the most incredible quarter, wrapping up what's been an incredible year. Big thank you to the team who's been toiling away, delivering those results. The shareholders and company partners and our stakeholders who all play a role in our business. So thank you all. Thank you for dialing in, and we look forward to talking again in the future. Thanks very much.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating, and you may now disconnect.